Have you ever felt like the door to homeownership is just locked and you don't have the key? You're not alone. With tough mortgage approvals and crazy prices, a lot of people are looking for another way in. So today, we're going to talk about that alternative path, creative real estate financing. Is it a brilliant lifeline or a really risky gamble?
This right here comes straight from a Reddit user. And wow, it just captures a feeling so many people have. You're trying to do everything right. You're getting over health issues, you're finishing school, but the traditional system just slams the door in your face. And you're stuck, just feeling like you're falling further and further behind.
I mean, it's a huge question, right? Do you just keep renting forever and hope something changes? Or do you start looking for a different way in? Maybe one that's a little, off the beaten path.
Okay, let's dive into exactly that. That alternative path has a name. It's called creative finance, and it's all about finding ways to buy a place without having to get a big bank loan right at the very beginning.
So here's the core idea in simple terms. Instead of going to a bank, maybe you work directly with the seller, or you find a different kind of loan. It's all about getting creative with the terms, the timing, where the money comes from, even how the ownership is structured, just to make the deal happen.
And believe me, there is a whole world of these strategies out there. You've got sellers acting like the bank, you've got partnerships with investors, the list goes on. But for our purposes today, we're going to zero in on one of the most common ones you'll see, the lease option. You probably know it as rent to own, because frankly, it's the one you're most likely to bump into in the real world.
All right, so let's really get into the nitty-gritty of this rent-to-own promise. On the surface, it sounds perfect, doesn't it? You get to move into the house you actually want to buy while you work on getting everything in order to, actually own it.
A rent-to-own deal is really two contracts smashed into one. First, you've got a normal lease, but you're probably going to pay a little more than market rent, and that extra cash usually gets credited towards your future down payment. Now, the second part is the option agreement. This is the legal key. It gives you the right, but not the obligation, to buy that house later at a price you both agree on today. That's huge. It means you can walk away, but the seller, they're locked in.
Now, what's really fascinating here is you can see the perfect win-win scenario. For the tenant, it's a clear shot at homeownership. You lock in a price, you build up a down payment, and you get time to fix your credit. For the landlord, they get a super motivated tenant who's going to take care of the place, steady income, and a guaranteed sale down the road. When it works, it's a beautiful thing.
But, and this is a big but, what happens when it doesn't work? The promise is powerful, sure, but the reality can be absolutely brutal. This is where that dream can quickly turn into a financial nightmare.
This quote, man, it's from a landlord on Reddit talking about a rent-to-own deal that went bad, and it just perfectly captures the frustration on the other side. They felt like they gave someone a chance, they took a risk, and the tenants just didn't hold up their end of the deal. It really highlights the tension at the heart of this whole thing.
So what does it all come down to? Well, the single biggest mistake buyers make is thinking the contract itself is the solution. It's not. The contract is just a temporary bridge. The real work is using that time, those 2, 3, maybe 5 years, to aggressively fix your credit score so that a bank will finally say yes to a mortgage. If you don't do that work, that bridge leads absolutely nowhere.
And that leads to some serious pitfalls. If you can't get that mortgage at the end, you usually lose everything you've paid in. That big option fee up front, gone. All those extra rent credits, poof, gone. And some of these contracts even stick you with paying for repairs, something a normal renter never has to think about. And then, of course, there's the market itself.
And this chart illustrates one of the biggest dangers perfectly. So let's say you signed a deal back in 2021 to buy a condo for $800,000. Now it's 2025, your time is up, but the market tanked, and that same condo is only worth $650,000. Well, a bank is only going to lend you money based on the current value, not what's on your old contract. You are now stuck with a massive $150,000 gap that you have to come up with out of your own pocket.
And that, my friends, is what it means to be underwater. You'd be moving into a home where you owe the bank way more than the property is even worth. You literally start with zero equity or even negative equity. It's a completely devastating financial hole that could take you a decade or more to climb out of.
Okay, that was the scary part, I get it. But these deals aren't all doomed to fail, not at all.
So let's flip this around and talk about the survivor's guide. How do you protect yourself? You just have to go in with your eyes wide open and a rock-solid plan.
Here are 4 things that are absolutely non-negotiable. 1. Get a full professional home inspection. If the contract says you're on the hook for repairs, you have to know what you're getting into. 2. Hire a real estate lawyer. I cannot stress this enough. This is not the place to try and save a few $100. A good lawyer sees the traps you won't. 3. Get every single detail in writing. The price, the timeline, exactly how much of your rent goes towards the purchase. And 4, have a financing plan. Don't wait. Talk to a mortgage broker on day 1 and build a real plan to get your credit where it needs to be.
This piece of wisdom from another Redditor just says it all, doesn't it? A handshake and a friendly vibe are great, but they mean nothing legally. A strong, clear contract that's been reviewed by a professional is your only real protection when things go wrong.
So after all that, where do we land on this? It's pretty clear that creative financing is a tool. And just like any powerful tool, it can be used to build something amazing, or it can cause a whole lot of damage.
It really is the definition of a double-edged sword. On one side, yes, it can open the door to ownership and offer some amazing flexibility. But on the other side, these deals are complicated, they're super risky if they're not documented properly, and they can fall apart so easily, leaving you in a much worse spot than when you started. So what is it? A lifeline? Or a trap? You know, the answer might be that it's neither. It's a high-stakes tool. The contract and the market, they're only part of the equation. The biggest risk isn't the deal itself, it's being unprepared for the deal. So the real question you have to ask yourself isn't, is this a good deal? It's, am I truly ready for this deal?